Today, I'm talking about what happens if you invest $100,000 in stocks versus real estate. We're going to be doing some examples and some back tests to see what happened if you did this over 25 years ago, and where you'd end up today, 2025. It's a great year to kind of test this 25-year hypothesis. So let's get into the video and let's learn a little bit about what the difference is between these two investments, which one is better and provides a higher return if you happen to have $100,000 right now. So we're going to be using the good age-old example of investing in an index fund versus home ownership as an investment. So let's start out by talking about leverage because it's an important principle and it can also apply to the stock market, but we're going to talk about maybe why that's not such a great idea. What is leverage and why am I talking about it? Leverage in its most basic form is borrowing money to invest with. You usually need to have some kind of backing to borrow that money to invest with. So for example, a bank might lend you $1 to $1 of money that you have in an account in order to invest with. So if I have $100,000, the bank may lend me $100,000 to invest with. It's 1-to-1. And if the investment goes down by 50%, instead of that $200,000 combined, if it drops 50%, it's $100,000. And if you were to do that in a stock account, in a brokerage, that money would get margin called, which basically means that all of your stocks would be sold off in order to pay back the $100,000 loan to the bank. So leverage is on the downside kind of a scary thing because instead of losing only the money you have, you can lose more than the money that you have. It is in theory possible if a stock rockets down to basically zero before the bank has time to sell it, and then you're in debt for $100,000. But the same can be said for the opposite example if stocks go up. So let's say a stock that you invest in doubles in value over a certain period of time. You would end up with $400,000 because you invested borrowed money instead of $200,000 with just using your own money. So your returns double, but your losses also double. So naturally, you also will probably have to end up paying interest and fees on the money that you borrowed. So even if you do make that extra return, you not only have to pay back $100,000 of the loan, but you might also have to pay back a little more. So for the sake of argument, let's call it $50,000. And by the end of the day, when you doubled your investment using borrowed money, you ended up with $250,000 instead of $200,000. So depending on how much the fees are, the risk might not really be worth the reward in leveraged investing, and it frequently isn't because of the negative consequences. A lot of investing is just avoiding loss. So if you can do that successfully, you are doing better than 90% of investors. So keep this dichotomy in mind. It's important to realize that yes, you can make astronomical returns if you leverage your money, but you can go broke just as quickly. So let's talk about real estate, the thing that we all live in. Let's figure out why on earth are we allowed to leverage this 5-to-1 or even 20-to-1 sometimes, and why that's okay. Because I just told you about how quickly you can lose money by leveraging 2-to-1 your money. So real estate is very frequently leveraged 5-to-1, if not more. So let's learn about why and how we have all as a society decided this is okay. And every bank and government has decided collectively that homeownership is kind of a right. This desire to make so many people a homeowner has resulted in lending policies that allow for this type of leverage to happen. I'm going to create two scenarios. In both scenarios, there is going to be a renter who is investing money into the stock market and who has a little extra money because they're not paying interest on a mortgage to continue to invest in the stock market. And then there's going to be the homeowner who has all of their money in the house and their payments are taking up all of the money they would have been investing otherwise. Kind of what people tend to do in this country as their investment, which is just dump everything into the home and the mortgage and hope it goes up in value. I'm going to do my best to find kind of real life rents. Obviously, it's not going to be a perfect example, but hopefully it's kind of illustrative enough to put the point across. So the first scenario is a 20% down payment, which is 5-to-1 leverage. We're also going to assume that our investments started 25 years ago to sort of see what would have happened if we had invested, I'm going to say 1999 as our starting year to 2024 because 2025 just began. So let's say you have $100,000 that you want to spend on a home. About $10,000 of that will go to land transfer taxes, fees, home inspection, etc. So after your cost of doing business, let's just call it $90,000. That means you can buy a $450,000 value home. So let's see what that gets you in the Greater Toronto area. I'm going to be looking at a suburb in this case, Mississauga, because I used to live there and I know the neighborhoods pretty well. One of the nicer areas called Lauren Park, you would get a 4-bedroom, 3 to 4 bathroom, 2,000 to 2,500 square foot home, 2-car garage, possibly a pool. And at the time, a 5-year fixed rate mortgage would have been around 7.5% interest. Your monthly mortgage payment at the time would have been approximately $2,600 a month. Add in all your other expenses to run the house. Let's say it's about $3,000 per month. Now, how much would the rent be on a similar home at the time? After doing a bit of research on the MLS, I discovered that it was around $2,300 to $2,500 a month for this size of house. So let's call it $2,500 after expenses again, $500 less per month to rent than to buy. Let's assume that the renter family put their initial $100,000 into an S&P 500 index fund, and the extra $500 per month in savings that they had from renting goes into this fund. So that's $6,000 per year. And let's just say that both succumb to lifestyle inflation with any increase in income, so their numbers don't change for the duration of this example. We're going to take the actual annual returns of the S&P 500. We're not going to do any averages. We're going to do the actual math. So starting with the renter family in 1999, you can see that their portfolio rose to $126,000. There were 3 down years immediately after that, and then a bunch of up years, and then the huge 2008 crash. And then after that, it kind of picked up a bit with a little bit of a downturn in 2022. By the time everything is said and done, they end up with a portfolio value of $858,000. We can look at the owner family by 2023 or 2024. Their home value, I looked up a similar sized home now in Mississauga in the same area. It would be between $1.65 and $1.75 million. And these are using actual sales numbers, so that's what someone actually paid for that home. And yes, maybe you would have had to put a little bit of money into renovations and that sort of thing, but again, lifestyle inflation, so let's just chalk it up to that. Due to the leverage that the mortgage allowed, you're actually almost twice as wealthy as the person who just invested in stocks. And this is something that's extremely important that a lot of people don't really realize about home ownership. Once you pay off the mortgage, you're basically living rent-free in the house. You got to pay your utilities and your property taxes and all this other stuff, but your housing expenses drop dramatically once you have a paid off home. And that is a huge benefit to owning the home. You no longer have to pay the bank rent, the mortgage, or as the renter family will continue having to pay, they'll have to keep paying rent, and that rent is going to keep going up. But as a homeowner, you have effectively eliminated one of the largest items in your budget. After this point, if you take that extra money and you invest it and you save it, you're going to see your wealth accelerate way quicker than the renter family. So maybe I didn't very clearly explain how the 5-to-1 leverage kind of worked in a house, but you can think of it this way. You're controlling something that's worth $450,000 that historically has appreciated in value. You only had to contribute $90,000 in order to obtain that. And as it appreciates, that $90,000 could turn into another $90,000 of home equity in like 2 or 3 years, even if you didn't pay a single dime on the mortgage and you just carried the interest. A 5% jump on $450,000 is like $22,500, while a 5% jump on $90,000 is $4,500. So it's literally 5 times the increase on every dollar. That's the power of leverage. Now, some naysayers may make the argument that yes, you are spending a lot of money on interest, you're burning that money effectively, but even after all of those fees and all of the interest paid, real estate is just in this scenario a little bit better of an investment. There are a million ways to invest in it, and pretty much every wealthy person that I know has invested in real estate or at the very least owns their primary residence rent-free. So let's move on to the second scenario where this leverage equation gets even crazier, if you can believe it. So here's a bit of a history lesson for you, and this is mainly for people from Canada, but even if you're not from Canada, you might find this interesting. The 5% down payment rule here came into effect in 1995. And after that, we proceeded to see 2 decades of the highest appreciation in the history of the Toronto real estate market and all of Canada for that matter. That was largely due to many government policies at the time, including interest rates coming down. So small details about the way that these low down payment mortgages work in Canada is that you can borrow 5% up to $500,000, and then it has to be 10% on the remaining amount up to $1 million. And now you can actually go up to $1.5 million. So let's say, for example, that you buy a $999,000 house. Your down payment will be around 7.5% when you combine the 5 and the 10% on the two $500,000. So it's not quite 20 times leverage, but it is close. So let's just say, for the sake of this example, that you buy a $999,000 house with 7.5% down payment, which would be about $75,000. And let's just say you burn the other $25,000 on fees and mortgage insurance, which is quite expensive. You can add that to the mortgage, or you can just pay it down at the start. Let's see what this basically $1 million budget will allow us to buy. So if we go back to the prestigious Mississauga, you could have purchased in 1999 a 4 to 5 bed, 8 bath, over 5,000 square foot house for that amount. Probably what you would call a McMansion nowadays. In 2023, this caliber of home sold for about $3.8 million to $4 million. Your monthly mortgage payments on that 7.5% interest rate would have been about $7,000 a month. Add on property tax and all the other expenses, you're probably looking at about a $9,000 a month expense to own this home. From what I can see online, to rent a similar property at the time would have been about $5,000, call it $6,000 after other expenses, which is a significant savings of $3,000 a month to rent versus buy, or $36,000 a year. Let's use the same numbers as before. We're going to take that $100,000 starting investment and put it in stocks for the renter family. So again, looking at this chart with all of our different percentages and all the years of the S&P 500 while adding $36,000, you can see that our portfolio kind of fluctuates quite a bit. And 2023, we're over $3 million. In this second scenario, because you're dumping so much money per year in stocks, you still end up within about $600,000 of the couple that purchased. This is another reminder that in this example, this time frame in history was one of the most prosperous appreciating time frames for stocks and real estate. Both of these numbers were kind of insane for 2.5 decades to basically see your investments quadruple in value. The purchasing couple still ended up with more wealth by the end of the 25 years. Just to stress this example, they no longer have to pay rent, and the renter family who does not own a home, yeah, they could probably buy a pretty decent house with $3.1 million and not have to pay rent either. You know, looking at this example, you can see how if you have a reasonably high income and you save even a little bit of it, $3,000 a month, you're going to be just fine by the time you retire. It's more likely that somebody would mess up a stock investing portfolio than they would home ownership because of the challenges of moving house. Most people aren't just going to up and sell their house on a whim, while you can do that in stocks. So now that we've seen both scenarios and both point to the fact that purchasing a home has been the better way to build wealth in Canada the past 2 decades, whether it's 5-to-1 or 20-to-1 leverage, will this be the same in the future? Many economists are predicting that the real estate market won't see these kinds of returns going forward, and we can kind of already look to the past couple of years and see that that might be true. But I still believe that the ability to leverage your money so highly, as well as the asset class being considered one of the most stable asset classes, at least for now, makes it a really great way to build wealth. And the ability to repeat this process with multiple properties and multiply the growth is something that you wouldn't really be able to do in the stock market without taking out leverage and risking a lot of your portfolio. Being a homeowner comes with a lot of stress, and it is a lot less passive than investing in stocks. So yes, you get a little bit higher returns, but it can be a lot more work. At the very least, you'll have a place that you can live rent-free. So that about does it for the video. Thanks for watching. If you found it interesting, let me know, and I'll see you in the next one. Bye.